Hi, everyone, and welcome to the Macro and Global Liquidity Analysis Gold, Silver, and Bitcoin monthly update for May 2024. We're putting this presentation together for our valued clients of the Ainslie Group, including Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard. I'd like to start off by welcoming our expert panel here today. How are you going, gents?
Very good, mate.
Afternoon, Chris. How are you, mate?
Afternoon. Now, it's really been quite a great a month for us, really. We've been preaching for the last little while, patience, patience, patience. We've started to see some action in the markets this month. So very keen to get into it today. But just before we begin, as we always do, just a reminder that everything said and shown in this presentation is intended for general informational purposes, does not take into account your particular circumstances, objectives, or situations, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. As I said, lots to get into this month, so we'll go through this format that we usually do: big picture, macro, then we zoom in a little bit to look at the global liquidity cycle, because our argument is global liquidity drives the big picture macro stuff. The macro cycles, we'll dig into the charts a bit and then look at our simple trading plan that we have. So straight into the big ticket item, the macro cycle, where are we? We have our chart we've been referring to every month. We've actually improved a little bit this month. Joe, talk to us about this chart.
So usually we've actually added 2019 through to 2020 as part of this macro indicator, just to give a little bit more perspective on historical performance. As you can see, coming out of 2019 into early 2020, we had the pandemic, and a lot of liquidity was thrown into financial markets, into the system via central banks or stimulus from the Treasury. So we had liquidity quite high, sitting at quite a high level for quite a long period of time, keeping in that mid-cycle part. And we saw a reflection of that in asset prices as well. So moving forward through to today, we're back in mid-cycle. We have slowly been pointing down due to slightly deteriorating conditions from that air pocket that we had during April, low liquidity, liquidity driving markets, driving the economy. In saying that, though, seeing that it's starting to tick down now is actually quite bullish in my eyes. When you think about a government with a slowing economy is going to want to stimulate that, and they generally do that by adding liquidity into the system and then into markets, which will flow on into the economy. So especially being an election year, I would expect that. I know we said this last month, but I'd expect that to start ticking up very soon as liquidity starts to flow through markets and then back into the economy.
Paul, adding this extra data really caught me off a little bit to see. It's like I'd forgotten that 2018 was really a horrible year, which obviously is off to the left of this chart. But 2018, we were really in that bust territory. It's almost like we forgot that all this stimulus and all this activity had been happening in the lead up to COVID, because we think about usually the liquidity coming after COVID, after we'd had all that shock, the whole world shut down. It actually really surprised me to see that it was such a relatively small period of time. It was a dip, and then we were back straight up into the those mid conditions again. What's your recollection of back at that time?
Yeah, if you recall too, there was plenty of talk of a recession coming, in 2019, and that COVID basically just triggered that or saved something deeper because of the response. You might draw analogies with last year as well, where everyone was talking about a recession, but if you followed what we were saying, then we were clearly in that early cycle coming out, and hence we had the share markets just ignoring everyone saying recession, and that was on a much broader scale, because you can see the scale of it there in 2020 with that COVID response. And Chris, the other thing with this, we have to keep reminding ourselves and everyone watching this, is that this is looking way beyond the US as well. So we've got, yes. And hence that we've got that bit of choppiness down here now in 24. Is it early? Is it mid? Is it early? But as we sit here right now, I think this tracks 18, 20 countries, and right now 20% of those are actually in the early cycle, and 70% are in mid. And then you've got two outliers, which are Japan and South Africa, throwing out late cycle indicators. So that's in part what's happening with that choppiness, where we're seeing US macro surprise data, as we wrote about in the news today, at a 5-year low. And exactly to Joey's point, when you're very clearly in that early to mid cycle, we are not in the late cycle. So this will be a stimulatory response, not a tightening. So it bodes very well, ironically, in our world of bad news is good news, is that the inevitable response will see us kick up to the right for sure.
And I want to dig a little bit more into that bad news is good news, because it is a bit confusing for people. And I know I've had this discussion with multiple people. They're going, well, sometimes good news is good news, sometimes bad news is good news. How does it all work? And I think looking at the US data, and remember always that disclaimer, the US is not the world. You just mentioned that. But when we look at the US data and the growth data, we see that we're right on this line, right? Like right on this halfway line. And the 50 line represents, if you're above that we've got growth occurring. This is the ISM data. And if you're below that, you've got contraction. If we're right on the line, why is that generally perceived as a good thing, Joe?
Well, it's exactly like Paul was saying. We're not in any serious expansion of the economy in terms of services or manufacturing, and leading, particularly if we're focusing specifically on the US. I know the US is not the world, but leading into an election year where they want the economy needs to pick up, or they want the economy to be strong to obviously they want to be voted back in, or Biden wants to be voted back in. They're going to want to stimulate that to essentially keep the people happy. So higher market prices, and generally stimulates the economy when you talk about financial assets as well. So,
and again, if we look beyond the US, about, so as you said, Chris, anything below that line heading up is sort of recovery phase, and anything above heading up is expansion. And we're almost, I think, 30% of the world's in recovery and about 40% is in expansion. So again, we're getting this, we're getting mixed signals across the globe, but they're generally in that reinforcing of that early to mid cycle, because we are seeing growth generally on the up. We're certainly not in any sort of contractionary sort of area, and there's a few in sort of a slowdown, but it's a world coming off high inflation, off the sugar hit of all the stimulus, and as Joey says, here comes the stimulus.
And the inflation story, you've made that segue perfectly, because we highlight this every month. Our leading indicator here still is indicating that probably inflation is under control for the time being, is how I would put it. It might be higher than where people would like to see it sit, but it's certainly come down a long way from those highs that we saw, the 2022 highs. I suppose, Paul,
under new control, maybe, Chris.
Well,
yeah. What's the new accepted norm?
So what's the new substitute for the basket?
And at a point that's a really good point, right? Because as we'll talk about it a bit later, but we've mentioned every month this idea of monetary inflation versus consumer price inflation. When you really add it all together, it's debasement, right? We understand it's debasement of currency. It's impacting people. Asset price inflation impacts people because they can't afford houses, right? They can't afford assets. Consumer price inflation impacts people because they can't afford groceries. So it's one way or another, they get impacted. And maybe the trade-off is that people or that the government is prepared to accept a higher level here as the base level. I mean, 2% is just a made-up number at the end of the day, isn't it?
Yeah, absolutely. And again, we wrote an article about this, I think, last week, that they are incentivized to have a higher than comfortable inflation rate, because inflation decreases the debt, and debt's arguably the biggest problem in the world right now. And again, leading to that early to mid cycle, mid cycles, we've got to remember that that's high inflation and rising growth. So it's consistent. Again, in today's article, we talked about Bloomberg's, just as they have a surprise macro index, they have one for inflation. Well, it's definitely ticking up. So there are still inflationary pressures there, which is the conundrum for the Fed and the cutting of the rates.
Which brings us to the area that's probably the scariest of all of this, the US government debt and yields. this chart, looking back over the longer sort of 30-year time horizon, it's really not a pretty picture when you look at the debt just continuing to go up, up, up. Every time we refresh this chart, we get a new higher number. And when we zoom in a little bit on that, what's starting to worry me is what's going on here. We're starting to see a tick up again. It's been relatively stable. We've managed, or not we, probably Janet Yellen and the Fed, between the Treasury and the Fed, they've managed to keep all of this pretty stable. But do we have the potential here for it to tick up, Joe?
I think the first thing to note is obviously the reason why that white line continues to grow is not just necessarily for one or two reasons. It's due to social security, defense spending, and also, most importantly, relative to this chart, the interest rate on the debt that's been issued. So we're currently at 5.5%, which really is a big problem when you're that much in debt. So in terms of how fast the economy is growing, but versus the amount of interest you're paying on the debt, the economy in the US is just not growing fast enough. So that's the reason, in my mind. Eventually, we do see those cuts, those rate cuts, which will drag bond yields down and make the servicing of debt a little bit easier. In the short term, starting in, I'm not sure how many people are aware, but currently, for the last 18 months, the Fed have been conducting QT, or quantitative tightening, which means they've been letting bonds roll off their balance sheet. So once the bonds are being repaid, the government repays the bonds back to the Fed. The Fed no longer invests that money back into the bond market. So what that actually, in a sense, destabilizes the market. So as of last month, actually it was earlier this month, they declared that they'll reduce their quantitative tightening from 70 billion down to 60 or 70 billion down to 25 billion. So it was going to be a cut of 35 billion. So that's 35 billion more that they'll be invested back into the bond market, which will help stabilize rates and add liquidity into the market to, what I assume, try and prevent those rates from ticking up higher and causing some sort of volatility event.
So they might want to do that, but the question is whether the market will allow them to do that. If it starts to spook investors, that they get worried that really, that there's going to be a lot more issuance of debt onto the market. They seem to be manipulating that by buying from the long end and selling more at the short end, which has a really
stabilizing effect. Yeah,
an appetite that people will continue to buy.
Yeah, so there's still, I think it's about 450 billion still parked in the reverse repo. So what the US Treasury are planning to do or currently doing are issuing bonds at the short end in terms of bills, which are just anywhere from 1 month to, can be up to 2 years, just those short duration bills, which banks are more than happy to pull money from the reverse repo to go buy off the government, and the government's reinvesting that money back into the long end of the curve, which is, generally speaking, at the moment, is the more volatile, is where they see the risk. So they're trying to stabilize the bond market in that sense. So you've got the QT going at the moment. You've also got the buyback program by the Treasury. Whether that's going to be enough to, stop those yields from creeping up significantly, time will tell. But it's definitely an issue, and they're definitely trying to do something about it.
So we'll know whether they're successful or not as we keep an eye on this chart, I suppose, because we'll see quite clearly if these start to take off and get unruly, and that will force a much bigger response. So moving,
why they had to do it, Chris, too. I mean, they're adding liquidity to a market that's just has a ever decreasing appetite for bonds for US Treasuries.
And that's such a good point, because people are becoming more aware of the underlying issue. So it doesn't just resolve itself with people going, let's rush out and buy as many bonds as we can. There's a general consensus that these are becoming less pristine, less always the reliable asset that they have always been. So that's a big issue. We believe our strong view, and it's not just our thought, it's backed by evidence, is that global liquidity is ultimately what drives these cycles. So that's what we look at next, to look at the liquidity cycle itself and where we are in that cycle. We had a discussion internally about this over the last couple of weeks. Paul, I'll refer to you on this idea that, again, and we've highlighted before, but people really don't understand that global liquidity isn't just what the central banks do. That, in fact, is just this little black part at the bottom of the chart here. There's all the rest of this. Can you explain what's going on here?
Yeah, because it's really, really important. So the fixation on central banks and what they're doing with interest rates and whatnot is overplayed. So the central bank money is literally just that black down the bottom. So you're looking at about 20 trillion of the 173 trillion at the moment. The whatever your color scheme is looking like, mine's at tan,
orange there.
White orange. That's the big player, and that is just that it's all the treasuries, sovereign bonds around the world as collateral for this liquidity. And as we saw in the chart before, there's been a settling of some kind in terms of the volatility of those. So we've actually seen the increase in liquidity in this last period has been because they're starting to settle down a bit. So it's just like your loan to value ratio on your house or whatever asset you're borrowing against. It's about how volatile or how secure that asset is. So as those treasuries behave in a more secure manner, the multiplier goes up, and you get that multiplication effect. And then that dark orange up the top is really just cross-border flows and that sort of thing. So it's other forms of money. Yeah.
Yep. And it's such a good point, because it's very hard to see on this chart, but if you really stare at it really closely, we have seen it flat to slightly down in the central bank, but it's actually a little tick up at the top, which is because of exactly what you just described, that multiplier effect that we're seeing, particularly in the bond market, or the collateral market, which is bonds and everything else attached to that. It's such an important part of it. When we go a little bit further into this, the question is, well, and I've seen debate on this on X, where people are back and forward on whether liquidity really does drive it. Anyone that's really questioning it hasn't looked at the statistical analysis, because when you actually go and do proper causation tests on the correlation, it's absolutely undeniable that global liquidity is causing the movement in world financial asset prices. So you can see a very, very strong correlation that is undeniable. And that's what we really hang a lot of our analysis on, because it's allowing us to peer into the future a little bit. Because as we see liquidity picking up, we can see, well, we know what's going to happen to asset prices as a result. The same when we see liquidity rolling over. And we've sort of talked about this, and we'll see this in the other charts ahead, but we've had global liquidity go through that down period. We've seen the bottom in October 2022, and since then been heading upwards. The latest sort of data we've got here, you can see that would be what, Joe, you were referring to before as the April liquidity air pocket. So yep. we've sort of come out of that. Do you think that this sine wave isn't proving anything? It's not saying this is what has to happen, but do you think that we're going to accelerate back up to catch up to this line? Is that how you see the rest of this year playing out? And I'll just in the process of that, I'll just sort of flip over to look at this chart, which is showing it in a slightly different way.
Yeah, so I think whilst that sine wave predicts that we're going to have, so if you just flick back to that previous one quickly, Chris, for me. Whilst that sine wave is predicting a top in liquidity in mid 2025, 2026, it's not always a straight line. Historically, we've seen plenty of instances where it's ticked up from the bottom and then had a correction down, and then it's generally ripped higher, playing catch up, exactly like you said. So based on where we are in the liquidity cycle, in terms of our macro cycles as well, like I said, election year, we've got sluggish economies around the world. I would absolutely expect that throughout the rest of this year to start ticking up significantly.
And how does that reflect here?
So just a quick rundown once again. COVID 2020, 2021, governments, central banks are stimulating lots of green, lots of liquidity in the system. Asset prices are rising. Inflation turned out not to be transitory. We started raising rates, or the US started raising rates 2022 to squish inflation. The rest of the world followed. We had a lot of tightening in financial conditions. We've now, since, as we saw from our previous inflation chart, inflation has started to come down, albeit a little bit higher than we generally would have historically expected. But we can see also that we're starting to go back into the green. and very, very light red shading. So that's basically a symptom of the tightening has significantly slowed, and we're starting to go back into expansion of liquidity, which is once again fantastic for markets.
Okay, so we also look at that through the weekly data, and this chart is spectacular. Paul, what's going on with this?
We're coming out of that air pocket, topically after a couple of actual air pocket incidents in the news, but and look, and we called that, and it's played out exactly as you would expect with these assets. So Bitcoin and gold and silver, gold to a lesser extent came off a bit in that air pocket, and that's a known. That's every April, a whole lot of people take money out of markets to pay their tax in the US, and then that coincided with China tightening things as well. But we've definitely seen a reversal of that through a number of mechanisms, and again, today's news talked about last night the ECB pretty much flagging straight up that they're about to ease, and they've been one of the central banks that have been tightening. And then, as I mentioned before, it's just that less volatility in the sovereign bond market and broader bond market has seen that multiplier effect, see the collateral marked up, and up goes liquidity.
And it just, to the letter, didn't it? Really played out exactly as we expected it would. We weren't sure how long that pocket would last, but I think you can say with increasing confidence that we've now passed the other side of it, because it's pretty compelling when you look at what the data has done. Joe, this chart, we've talked about this before. What some people are concerned about is that we're now starting to see the monetary inflation hedges, get my words right, monetary inflation hedges of gold and Bitcoin really take off beyond what the capacity is of the global liquidity here, because they really have. And in the longer term, this chart is just beautifully over a very long period of time, back from the mid-1970s, shown the correlation that we have between global liquidity and monetary inflation hedges. What do you say about what we're seeing in really this takeoff here?
So the yellow line is just to clarify, gold and crypto are that yellow line. That's the value of gold and crypto together relative to global liquidity being the black line. Now, that black line currently, as it sits there, is slightly forward-looking into next year. Mm-hmm. In my opinion, I think what we're going to see is that black line is going to significantly rise, just like the global gold and crypto prices have over the last 12 months. And the reason for that is simply because, like we've already discussed, in terms of the world governments wanting to stimulate. Paul was just talking about the ECB. We've got the British there looking at cutting rates. The US potentially towards the end of this year. And, even if they don't cut rates, that's not everything as well either. Like, they're still able to get liquidity in through the back door without anyone sort of noticing anyway. So the governments want to keep the economies alive. And I think, once again, that black line is going to just about run parallel with that gold line as we move in towards the back end of the year.
We've got to remember too that gold line has seen two events, two market actions where we've seen the ETFs introduced for Bitcoin, which saw an enormous amount of take up there, and we saw central banks just doubling down on their purchases of gold as well. So we've had some drivers that, particularly from a central bank point of view, you could say is front running, because they know better than anyone the mess that's before them. So it does make sense a bit that it has taken off ahead of that tick up. And I agree with Joey. I think it's not a matter of if they increase liquidity, that they have to, right? So we know as this keeps going, and you can apply a parabola to that line almost, this is a market that just has to keep monetizing debt to pay for the previous debt. So it's going to just keep building. It has to, otherwise it falls apart.
And I'd just like to dig into something, Joe, you mentioned about the backdoor approach to this, right? Like, I think what's also really important to understand is that the global liquidity entering the system is entering in a slightly different way to what it did last time. It's not always well, it's not labeled the same, at least. It's not quantitative easing as we know it. There's other programs and other things in place. Do you want to talk about that a little bit?
Yeah, so if we're looking specifically, just as one example, as the Fed balance sheet, so they're conducting QT. And in terms of the assets on the Fed balance sheet, we're seeing that fall, and everyone's like, well, that's liquidity negative. Well, that's not exactly true, because there's different types of assets that exist on top of inside of the Fed's balance sheet. So, you got mortgage-backed security, you've got bonds, you've got different durations of bonds, you've got the discount window for banks, which, they've got programs like the BTFP last year with when we had the banking crisis. That was liquidity positive because they were able to get liquidity through basically buying bonds back at par price. There's lots of different ways, and particularly sneaky ways that get liquidity into the system. And of course, like I said, that's just one example. That's just the Fed. When we look at liquidity, it's globally. So there's lots of sneaky ways for that to get that up with, while it still looks like the balance sheet of the central banks are falling.
And I've heard some specific examples recently about the trips to China, right? That we've got US officials, high-ranking US officials making trips to China, potentially talking about swap lines to increase US dollar liquidity going to China. All this stuff is liquidity positive as well. I know you talk about a lot of that sort of thing in the news articles as well, Paul. Like there's many examples that you come across, aren't there, where there's backdoor, side door, other ways to get liquidity into the system.
Yeah, and now to go back to Joe's comment, the rates, Michael Howe, the guy who actually put this chart together, often talks about when you have to refinance your house, you don't care what the rate is, you have to refinance your house or you're homeless, right? So in a world that's got, $350 trillion of debt that, on average matures every 5 years, well, you got 70 trillion every single 5 years. Like rates doesn't matter when you have to do it, right? So they will have to, and the only way you can do it is keep producing liquidity in some way to pay for that debt. And as I said before, which then creates more debt, and we get this cycle that feels a little bit exponential in its trajectory.
It certainly does. And we'll now go and look a little bit specifically about the assets and how they're responding to this. So everything we've just talked about in terms of liquidity, how that's flowing through into what we're referring to as macro assets. And they're the assets that we believe are monetary inflation hedges. So we talk about gold, silver, and Bitcoin. We'll go through this fairly quickly because there's been some updates we can talk about, but ultimately these are a longer term play that we're looking at. But starting with gold, we've got the consistent proof. We've shown that the cycle highs line up, the cycle lows line up with the gold cycle. But recently, this chart's one of those that is really quite impressive. We've had the global liquidity air pocket, we can see quite clearly showing up, it's ticking back up again, but gold's taken off. Paul, talk us through what's likely driving this big move higher in gold.
Was mentioned before, central banks have been very big buyers, because don't forget, we're in a context of ETFs actually bleeding, right? So the Wall Street's selling because computer says high interest rates sell gold, but your central banks are buying, and then you've got the likes of China beyond the central bank purchases, but China consuming an enormous amount of gold again. So it's just supply and demand, and the weak hands that are selling, albeit in synthetic vehicles like ETFs, are not keeping up with the strong hands that are forward looking and getting ahead of that little red arrow down the bottom, starting to get carried away. And
I think that's the most important piece to take away from all of this when you're looking at gold. If this is being driven by central banks, they're probably in the best position to know what they're about to do. So
don't do as they say, do as they do.
Do as they do. And if the flows from retail are going the other way, that's pretty interesting. Silver probably tells a similar story. I mean, obviously it lines up in terms of our highs and lows, but the chart here, I mean, we've seen really some quite spectacular moves in silver. Are we at that point in the cycle, and we'll talk about it in a second with the gold silver ratio, but are we at that point in the cycle where silver plays catch up, takes off? What's going on with silver?
It really shouldn't. It's getting a little ahead of itself. So normally you would expect to see this sort of action later in the cycle. and silver, you know, in Aussie dollars, we're at all-time highs, right? So in US, though, we are still well below. So we're at, what, 32, 35, 31, 32 US dollars.
It's a little higher than this because this is, of course, the average price for, will be the average price for April. It's gone up again.
Yeah, and previous all-time high in US dollars were 48. So it's a long way away, and hence why that gold-silver ratio we're about to look at is still so very high. But again, silver, so we're in this space where commodities should start to look good, and silver wears those two hats of monetary metal and an industrial metal. So and you know, it's well documented that we've got, you know, probably 5 years of deficit supply for silver. So there's natural market moves going on, I think. But you know, the real action is probably still some months away. But you know, silver can do what silver can do. It might take off earlier than we expect. But
silver does what it wants when it wants.
But you know, we're still in the mid-80s, right? Against a 100-year average of 40. You know, silver just has, well, literally double the potential from here just to get back.
And yeah, that was the point I was about to raise. You keep reminding me every time when I go, oh, yeah, is it turning down now? You go, well, just remember this GSR is very high by historical standards and has been high now really for quite a while. Because even at the lows of the GSR back in 21, it still was what, 65 or something. It was still very high by historical standards. So we are still, there's so much potential ahead that we could be seeing the tick up now and still expect a big move ahead later in the cycle.
Well, in 2011, I remind you, we were at 30 to 1.
Yes.
Right? So that was the last time we were at $48 Aussie, but it was 48 US at that time. And we're having this conversation at 32. So the potential in silver, again, given all the ESG and everything that's going on in terms of solar panels and electronics and everything, it's got good uses, and it's got great monetary metal properties as well. So it really should, you know, ride the wave nicely.
Joe, we'll have a look at Bitcoin. We start with Bitcoin, just reminding everyone this chart that's been updated recently. We've got this 86% correlation between Bitcoin and global liquidity. This is a slightly different global liquidity index, but the proof is still there. Very high statistically proven correlation. It's almost like Bitcoin wants to, you know, be the metric that measures global liquidity. What do you have to say about all of that?
It's a good reminder why we follow global liquidity so closely. Like the correlation 0.863 is extremely high for anyone that doesn't usually follow this sort of statistical analysis. The reason it's probably not higher or isn't higher is because due to the volatility in the speculative phase of Bitcoin, for example, where it gets ahead of itself. So that's why, you know, being so sensitive to liquidity, yes, it can get ahead of itself, but also we're watching liquidity for the downturn because that's when we want to exit our Bitcoin position, because you know what's happening next. You're just going to get carved to pieces.
Yeah, because it really has proven to be the asset that best responds to what's going on in the underlying liquidity situation. With that in mind, this chart this month has really been quite spectacular. There's been a lot of noise, and the criticism of this chart is always, well, it doesn't show you the big bars that went up and down. I say, well, I think that's a feature and not a bug of this chart, because what this is doing is showing you the average price of the month, and really it's not moved, right? We've had all of that volatility, but when you look in terms of averages, it's been very well behaved right through the liquidity air pocket. So what does that tell you about the strength? Because to me, it seems that's a very bullish sign. Do you interpret that the same way?
Yeah, 100%. So Bitcoin being extremely sensitive to liquidity, but also forward-looking, it's, in my mind, it's predicting, like, the reason we haven't seen it sell off more, historically speaking, a 23% drawdown, which we've had from 74 down to 57, I think it was, is, while it may seem like a serious drawdown, it's actually not that much historically if you look back through the price history of Bitcoin. So the market knows the liquidity is coming and that fiscal and monetary stimulus is coming, and I think that's why it's been so resilient. And I look forward to watching this chart for the rest of the year.
And it's very exciting for me the second half of this year, because the bounce we've seen already in Bitcoin there, it had that drawdown. But when we look at the average, right now, the price, like when we get the average for the next month, is probably not going to have moved much at all anyway, because we're right back up there again. So the bounces have been great. You've had very short amount of time to take advantage of those dips. It really seems like it's been all over it.
And like we've been saying for the last couple of months, based on our forward-looking analysis of liquidity, all these dips have just been buying opportunities, and so far it's been proven right.
And you've been saying that very consistently every month.
Won't be without its challenges, though, Chris. You're going to have to keep reworking that right-hand scale.
Absolutely. As we did back here, when you look at that, it looks like it was flat. There was actually a lot of movement in there, but when it just moves so much, it's a very challenging chart. This monthly macro and global liquidity analysis is brought to you by the Ainslie Group, Australia's trusted choice to buy gold, silver, platinum, and crypto online or in our Brisbane and Melbourne showrooms. With over 50 years of operation, we're your reliable partner in wealth management. If you're looking to buy tokenized gold or silver anywhere in the world, check out the Gold and Silver Standard for the security of real-world assets combined with the flexibility of blockchain. Okay, we always provide this we've just talked about Bitcoin. We've had a very good trade in place for a while now, which is really a simple strategy that we think people could follow along with quite simply. The idea is we look for that global liquidity index to try and determine where we are currently in the cycle. And when we think we're at the low of that cycle, we buy. When we think we're at the top of that cycle, we sell. And this is what the chart looks like. So far, we've had really spectacular returns. The buy was the low in global liquidity was October 2022 that we've talked about many times. We had a buy signal that we were confident on January 10, 2023, which was we'd had some time for that low to be confident that low was in, and we were seeing a little bit of movement there. It looks like nothing, to Paul's point just previously, it looks like nothing now, but it was a big move at the time when everything was very flat. And since then, it's just been off like a rocket. We've got some signals over the top there. Joe, do you want to just quickly talk about what these signals are over top of that and how they can be useful?
So this is actually a Bob Lucas chart with these 60-day cycles, and what it helps, it's in his predictive power of the 60-day cycle. Anyone that's followed his work, you're generally looking for those bottoms around with the 60 days in between each bottom to help you try and predict where the bottom of that 60-day cycle is. And generally speaking, it's historic. It's not always 60, but
no.
It's if we had 42 last time, which sort of some people are expecting another lower low, which hasn't eventuated yet. But it generally speaking, around the 60 days, if you get a low somewhere 10 days either side of that, it's an excellent buying opportunity.
And it really just helps us psychologically, I think, is how we tend to use it as well, to go, well, okay, we're into this 60-day cycle now. We'd probably be expecting a high sometime soon, or not necessarily soon, but we're well into it. We're almost halfway through. So you'd be expecting a high at some point. It just gets you used to that idea that, yes, there will always be pullbacks, but you're only ever really a couple of months away from the next cycle. So paying a little bit of attention helps.
Yeah. It's really quite powerful, like you said, just for setting expectations. It's not always up and to the right, and it's not always down and to the right either.
Yeah. And that's all it's about, understanding the markets do go up and the markets do go down, but also identifying that stronger underlying trend. In terms of this particular trade, we bought at 17,179. We're currently over 300% up, but that's been over 504 days, so 220% annualized. Really, it just highlights very clearly with a real example, because we actually did that the play here is to identify these cycles and hold them for the long term.
Yeah, that's right. Not trading in and out. Like, I know we had Bob's chart there in the previous slide, but once again, that's for setting expectations. Not generally, we wouldn't be necessarily trading around that. Yeah,
we're the world's most boring traders, but so far it's proven very profitable.
100%.
Well, that's us for this month in terms of all the big picture stuff we wanted to cover. As we do each month, we'll sort of end with your final thoughts and thinking for the month ahead, or just final comments that you want to make. Paul, we might start with you.
Look, I think we're just looking for, I guess, reinforcement that we're out of that air pocket, which I think we've seen, and maybe more of watching what the Fed do, not say. You know, a lot of that pullback on Friday was just Fed minutes that talked about, yeah, we're probably not going to cut rates. You know, there's jawboning at play here as well. So I think, again, just like we talked about central banks and buying the gold, I think we just keep a close eye on what they're doing rather than what they're saying, and watching that global liquidity.
Joe?
Yeah, 100% agree with Paul. I'll continue on by saying what I've basically said the last couple of months is based on our analysis and liquidity continuing to rise throughout the rest of this year. The pullbacks, whether it be gold, silver, or Bitcoin, they're for buying, not to be shaken out on. Not financial advice.
Financial advice. Don't FOMO. I agree with all that. I'm really very excited for the second half of the year. We're almost there. We've been saying this for a while. As I said at the very start, you know, we've been really preaching patience and had to wait and wait and wait. But it feels like things are starting to move, and the setup is really there for quite a spectacular second half of the year. So I think in these updates ahead over the next few months, we're going to be seeing more of the same, more exciting news as that liquidity really picks up and pushes everything up with it.
Yeah, looking forward to the next month for sure.
Well, thanks everyone for watching our update for this month, and thanks to Joe and Paul for your contributions in that analysis today. We always value feedback and discussion, so you can follow me on X at Tipper Analytics to stay up to date or to reach out. We'll be back in June with the next update to reassess and identify what's changed. Until we chat again, good luck in the markets.